What's going on, guys? It's Rohan here. So can 3% be the new 2% for inflation rate targets by central banks? In this video, I will discuss the possibility of that over the coming years. And if we have not met before, very welcome to my channel. First, let's quickly take a look at this report that was published by Goldman Sachs pretty recently on November 10th, 2022 this year. And is 3% the new 2%, sizing up a scenario of higher inflation targets? So the key points from these reports are pretty much these two, that while inflation is the dominant economic variable that central banks have chosen to target, there is nothing sacrosanct about the current 2% inflation goal. And the next point is there are reasons to believe that higher inflation is neither transitory nor persistent, but rather structural, driven by forces such as aging demographics, deglobalization, and decarbonization. As a result, policymakers may need to revisit the appropriateness of 2% inflation targets. Now, the part of the report that I want to specifically point out here is this part where they are saying various constraints, very hard constraints before any such implementation of changing from 2% to 3% is possible. So they said that there are numerous and significant challenges in doing so. First, to float the possibility of a higher inflation target just when inflation is egregiously above target might be seen as shifting the goalpost, and admission by policymakers that bringing inflation down to 2% is just too hard. In that case, there could be significant damage to policymakers' credibility. Second, both the Fed and the ECB recently adjusted their inflation regimes, and to make changes on a regular basis could be seen as detrimental to stability and predictability, the very things that inflation targeting is supposed to engender. Third, for many central banks, the decision on their remit is inherently political. The specified target is not freely determined by monetary policymakers themselves, but by democratically elected politicians. Any change in mandate is therefore not a purely technocratic one, and it may be that these questions will lie dormant for some time before being considered in earnest. Alright, with that, let's look into the situation that we currently have. But first, the necessary and important statement that this video is not an investment advice and it is only for educational purpose only. So is it really possible that we will return to the persistently low inflation that has characterized the last 2 decades, or will it remain at a higher level? In my opinion, 3% will become the new 2%. This has significant ramification for investors. Part of the story involves a higher and more variable rate of goods price inflation. Goods prices are expected to be exposed to periods of commodity price inflation in the future, similar to what we have experienced this year. Following Russia's invasion of Ukraine, the West lost a significant supply of variety of commodities. If goods inflation remains chronically high, central banks may argue that they will simply have to push service sector inflation lower. While theoretically right, the political reality is less obvious, and the reason is, in a complete reversal of the previous 30 years experience, Western service sector workers in that case would have to accept wage growth that's lower than the global good prices rise or the global goods prices inflation. Hence, given all these constraints, what I believe is that central banks will rather accept a somewhat higher inflation rate. This is because a 3% inflation target would raise the average nominal interest rate by 1 percentage point, all else being equal, and this would lower the possibility of reaching the zero barrier, which is a point at which the interest rate can no longer be cut to encourage the economy, and forcing central banks to use unorthodox policy measures such as quantitative easing. It is now quite evident that the quantitative easing is not a substitute for normal monetary policy, because it entangles a central bank with the government in such a way that their independence or views of their ability to operate independently are jeopardized. Now, the concept of raising the inflation target until the most recent round of high inflation is over is likely to be rejected by central banks. But as an investor, you should examine the implication of a world with slightly greater inflation. Bond investors would be wise to abandon the concept that 3% is a long-term neutral nominal interest rate. They should demand a greater yield than they have in the previous 2 decades on average, as well as a risk premium to reflect the increased volatility. Now, the consequence for stock investors are less apparent, as earnings will grow at a little faster rate, but gains will also be reduced as interest rates rise. A steeper yield curve could assist global financials but hurt technology companies, for example. As a result, global value equities would outperform the growth stocks. It may sound ironic, but dividend yield stocks may be a good bet in high inflation scenario. You can argue that high inflation means that you get lower dividends in real terms. That is true, but we are looking at stocks that will hold value. That is because for high dividend yield stocks, their dividend value acts as a support below which the price normally does not fall. In fact, any dip leads to value buying, and you can take advantage of that. Also, try your hand at global ETFs. They can offer inflation protection. And further, inflation indexed bonds and variable rate bonds could be a good choice for debt investors during high inflation scenario. In times of high inflation, don't get tied down to fixed return bonds with long maturities. That is bad debt strategy at this time. Such bonds will see more price depreciation because higher inflation raises the prospects of a rise in bond yields. Variable rate bonds or inflation index bonds will see the yields go up with the market scenario, and that means price damage will be very limited. And as an end note here, I definitely need to mention Warren Buffett's advice here. During a 2015 shareholder meeting, he noted that the best businesses during inflation are the businesses that you buy once and then you don't have to keep making capital investments subsequently, while you should avoid any businesses with heavy capital investment. He highlights real estate as good during inflation, which you may buy once and then also get the rise in value as well. Meanwhile, he calls out businesses like utilities and railroads as not a good investment strategy during the inflation scenario. That pretty much wraps up this video. If you liked it, do smash the like button, and also don't forget to subscribe. See you in the next one.